Hello, and welcome to the latest installment of Legal Bites, the official podcast of Cummings and Cummings Law, where we focus on helping businesses and their owners re-domesticate out of volatile legal and tax environments like the formerly golden state of California to more predictable pro-entrepreneurship, pro-growth jurisdictions. Today, we are reviewing a recent report by the Financial Times entitled A Wealth Tax in America. There's a question mark. Not if Silicon Valley's billionaires have their way, referring again to the ongoing exodus of businesses and people from California, as I have reported in several earlier presentations on this podcast. But first, a brief introduction. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, and commercial law. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's degree in accounting and a master's degree in taxation, in addition to 11 professional licenses and certifications covering accounting, tax, audit, and of course, the law. My firm website is www.cummings.law, as reported on earlier editions of Legal Bites and in the Financial Times article by expert journalist Stephen Foley. California is about to hold one of the most consequential ballot referenda in modern American history. On November 3rd, voters in California will decide whether to impose a one-time 5% tax on the net worth of every billionaire residing in that state as of January 1st, 2026. The proposal, championed by the SEIU UHW union boss Dave Reagan, is designed to replace federal healthcare funding that the state lost under President Trump's One Big Beautiful Bill Act, which was signed into law a little over a year ago on July 4th, 2025. An estimated 3.5 million Californians stand to lose healthcare coverage absent a new funding source, according to Reagan. And he frames the math as simple. California's billionaires saw their collective net worth grow from $700 billion in 2019 before COVID to $2.1 trillion by the end of 2025, a 212% return in nominal terms. He seems to have forgotten about something called inflation, but we'll set that aside for now. A 5% haircut, he argues, would bring that return down to only 207%. And in Reagan's words, nobody would notice. Well, I'm not so sure about that because the billionaires have, in fact, noticed. Google co-founder Sergey Brin has committed $82 million of his estimated $270 billion fortune to a campaign group called Building a Better California, which has collected more than $100 million in total. And the donor list reads like a who's who of Silicon Valley: venture capitalists John Doerr and Michael Moritz, cryptocurrency entrepreneur Chris Larsen, the founders of Stripe, Affirm, and DoorDash, former Google CEO Eric Schmidt, and several others. In all, at least $129 million has been raised from billionaires to defeat the measure. By contrast, Reagan's union has allocated $30 million and hopes to attract additional support from sympathetic unions nationwide. The opposition has not limited itself to advertising. Building a Better California collected enough signatures to place 2 spoiler proposals on the same ballot. Now, this is interesting. Each is designed to nullify the wealth tax if it receives more votes. The more potent of the 2 would actually prohibit taxes on retirement holdings and personal savings, which, despite having nothing to do with billionaire level wealth, polls at 76% support when described in those same terms. Framing is everything. The wealth tax itself polls at about 55%. I think it will pass. That's just my personal opinion, because that's the way the wind is blowing. If both measures pass, the one with the higher vote share controls and the so-called spoiler measure could therefore negate the wealth tax, even if a majority of voters support taxing billionaires. Now, as I've discussed previously and at great length, there has been a flight response. Brin himself relocated out of California before January 1st of this year, the retroactive date on which the tax would apply to California residents. And as I reported on yesterday's edition of Legal Bites, the California Franchise Tax Board in Sacramento has responded in kind by doubling down on residency audits, not just for billionaires, but for small and medium-sized business owners as well. Now, Brin now lists Nevada as his residence in campaign finance filings and has reportedly transferred business assets out of the state. Well, yes, reportedly. I reported on that in earlier editions. Larry Page, Peter Thiel, and Uber co-founder Travis Kalanick are among others who appear to have changed their primary residence before the deadline. A wealth advisor named David L'Esperance told the Financial Times he has helped 7 billionaires leave California since the proposal became public. I don't usually work with billionaires, but I have personally assisted a number. I'm not even going to say the number because it's going up every day, but we'll say hundreds of small and medium-sized business owners evacuate California, not because they worry they're going to be affected by this imminent tax proposal, but because they are worried about future tax proposals. Remember, as we discussed in an earlier episode, I shouldn't say all, but at least one of the authors and proponents of this proposal has admitted on record it will not be one time. And Congressman Ro Khanna, representing California in Congress, has said, well, really, 1 billion is the wrong number. It needs to come down to 50 million. You can see where the trend is heading, but I digress. Now, this exodus has divided California Democrats. Governor Gavin Newsom, who I will say has great hair, tried to persuade the union to withdraw the proposal, arguing that a state-level wealth tax would drive the wealthy to other jurisdictions. Well, on that, Governor Newsom and I agree, and he has been proven correct. Other California unions, unhappy that the proceeds would be earmarked solely for health care rather than shared with other priorities, have also declined to support the measure. With an eye on a presidential run in 2028, Newsom prefers to advocate for wealth tax measures at the federal level, which, as I said, are being championed by Congressman Ro Khanna and Senator Elizabeth Warren instead. Betting markets give the California tax less than a 1 in 3 chance of passing. Well, we'll see. I think they may be confused on that likelihood. The intellectual foundation for the proposal comes from French-born economists Emmanuel Saez and Gabrielle Zuckman at the University of California, Berkeley. They worked with the union to simplify the economic arguments for public consumption and have sparred very publicly, I might add, with rival academics over whether billionaire flight would erode the tax base. That's interesting because France used to have a wealth tax on billionaires, and it was a failure, as we reported in earlier editions, and France actually ended up repealing the measure. So I guess they didn't learn anything from history. Their position, as I understand it, is that the economic damage of the departures is negligible. Saez told the Financial Times that the decision to target billionaires specifically rather than a broader class of wealthy residents was deliberate. Of course it was. Fewer taxpayers, a manageable administrative burden, and a clear framing of the debate as billionaires versus healthcare. Opponents have pushed back hard on that framing. One prominent venture capitalist has called the proposal an everyone tax. I have not heard that before, but I'm going to start using that, predicting the legislature will repeat and extend it to less wealthy Californians. Remember, one of the proponents of the bill, I shouldn't say bill, it's not a bill, but of the proposition, have said that is exactly the game plan. Michael Moritz made the same point more bluntly, asking whether anyone has ever heard of a one time tax. Touche. Saez concedes the point from the other direction. If this measure passes, it does make future wealth taxes at the state and federal level more probable. He considers that a feature, not a flaw. These people cannot wait to get their hands into your retirement funds, checking accounts, and your kids' college funds. The former campaign, I should say formal campaign, excuse me, begins next week with the publication of official arguments for and against the measure. Heavy advertising will follow in the fall. This is already shaping up as one of the most expensive referendum battles in California history, if not the United States, and its outcome will be watched by policymakers and tax planners worldwide. California will try it first, as they often do, and other states will follow. Mark my words. New York and Maryland are my predictions for the next two. We'll see if I am proven correct or wrong. And by the way, I love being wrong because that's when I learn. Now, with all of that in mind, I mentioned I have worked with a number of clients who certainly are not billionaires by any stretch of the imagination, to redomesticate their existing small and medium sized businesses out of California because they see where this is heading. With that context in mind, redomestication is the lesser known legal process of transferring a company's state of domicile to a new state without dissolving it, without creating a new entity, and without triggering federal income tax, but only when performed within the strict formalities required by the Federal Internal Revenue Code, applicable Treasury regulations, and the statutory frameworks of both the destination and departing states. Let me stop here. California absolutely allows redomestications for LLCs and corporations. LLCs, they have allowed for a number of years. In corporations, they have allowed since 2023. So if you have a so-called professional saying, oh, California doesn't do this, it sounds great, but California doesn't do it, they don't know what they're talking about, and they are at least 3 years behind the ball. Now, the company, when executed by a competent professional, the company retains its existing federal employer identification number, contracts, credit history, and bank accounts. That is to say, there is zero operational or financial disruption. And as I mentioned, I have successfully completed redomestications from all 50 states and for limited liability companies, partnerships, subchapter S corporations, and subchapter C corporations. And not to brag, but so far we have had a 100% success rate. Of course, there's a first time for everything. Having said that, we've gotten pretty good at doing these. Foreign entity registration is not the same thing as redomestication because foreign entity registration, also referred to as foreign qualification, amongst other misleading and convoluted terms, does not change the company's legal domicile. It does the opposite. It keeps the entity in the former state, California in our example, indefinitely, meaning you continue to pay that $800 annual fee to your friends at the Franchise Tax Board, and merely adds a second layer of compliance and tax obligations in the destination state. Meanwhile, a traditional merger, which is also not the same thing as redomestication, creates a new distinct entity in that destination state, may and often does require the issuance of a new federal employer identification number and can trigger serious tax consequences. Finally, dissolution should not enter the conversation at all because dissolution terminates the company. There is nothing left to move. Dissolution is a going out of business mechanism, not a relocation maneuver. Dissolution is often a taxable event, and when performed inadvisedly, can expose the owners of the company to unlimited personal, repeat, personal, joint, and several liability for the company's liabilities, known and unknown, because the so-called veil no longer exists. If you have a so-called professional suggesting dissolution as a relocation mechanism, please seek a second and third and fourth opinion if necessary, because there's so much bad information out there. Redomestication, when paired with the change of personal residency and this is an important a reduction or outright cessation of business operations in the former state can reduce or even eliminate state tax exposure there for the entity and its owners. Don't take my word for it. Ask your CPA. Now, the elephant in the room. If you move out of state and you move your company out of California, but you still do business in California, you will still pay California taxes, period. If somebody is telling you otherwise, they don't understand tax nexus. My first job out of grad school many years ago was doing state and local tax returns for venture capital and private equity funds. I probably did 1,000 California returns during that time. So if you ask your CPA and he or she gives you a blank stare, you probably want to speak with somebody that understands multi-state tax nexus. That's my diatribe for today. So, in conclusion, now is the time to consider acting before the California State House changes the law to hinder or even eliminate the option of redomestication. If you have questions regarding potentially redomesticating your existing LLC or corporation out of California or out of another unfriendly state, please use the link in the description for more information on this process and to schedule time for you and I to speak one-on-one about your specific scenario. Again, my name is Chad Cummings, and I hope that you found this information illuminating. I used to say helpful, but illuminating sounds fancier, so we'll go with that. As always, the information in this presentation is necessarily general in nature. It is not legal or tax advice, nor should it be construed as such, because that advice definitionally must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my many earlier presentations on this timely topic, please visit my firm website at www.cummings.law, not .com, but .law to schedule time for that consultation. I look forward to that opportunity to speak and perhaps even work with you very soon.